Okay, let's put all of this in context. I've got Sameet Chavan, technical analyst at Angel Broking, joining us for a technical view on this. And we've got Deven Choksi from KR Choksi joining us on the fundamental take. Deven, let me start off with you. What a fall we've seen. And I was just looking at the Nifty chart all the way from 2013. And what stood out was that last time we were at these current levels, it was May 2014, just when Narendra Modi was sworn in after that spectacular victory for the NDA. So in the time frame from there, we are just about where we started off with this government. This last bout of weakness has been because of the global volatility, Deven. But what do you see when you see a market like this?
Well, many, I think, interesting observations, I think, between two periods. I think when one looks at the past, one would probably find that India was on the receiving end of higher crude oil price, threat of depreciating currency and lower growth.
Sure.
Today, I think we are in a complete contrast. We are having a lower crude oil prices, relatively stable currency, and a possibility of, I think, a very high level of growth, given the kind of projects that the government has spelled out. So on one side, if the economy is showing all the signs of growth, on the other side, I think the market is not. Probably the market is suffering also because of the collateral damages that it has to pay for due to the sharp fall in the crude oil commodity and the commodity. $2 trillion worth of, I think, losses to the oil-producing nation is basically asking for selling of their assets in elsewhere, and that's where I think India is victimized. I would think that the current levels of valuations in the market, they are quite compelling, quite attractive, and I would think that India as a country could possibly produce earning growth of double-digit easily over the next 2 to 3 years on a sustainable basis. So given that kind of a possibility, I think these valuations, the current prices in the market, they remain a very attractive opportunity for next 2 years or so if investors want to. One of the factors, I think, which probably is not going well with the market is that most of the investors have turned traders, and that's where I think there are larger amount of volatility also in the market. If something has to be done, I think, for basically, I think, bringing the kind of investors back into the market, from 30,000 crore volume in cash market to 350,000 crore worth of volume in derivative market. If this kind of polarization is there towards speculation, I think the volatility would be high, and that has to be corrected. Otherwise, I feel that I think the fundamentals are right in place.
Right. Deven, you know what, the sense that I'm getting from all the analysts we speak to, including the special that we had with Madhusudan Kela, Ramdev and Rhythm, is that India has never looked better on a fundamental context, especially amidst this global turmoil. And I think the general message is hold on. But I am going to ask you, what is happening in the trading room right now when there is such a lot of nervousness and uncertainty in the global market? How do you see this panning out in the immediate short term? Are people caught with positions? Is the unwinding going to continue? Give us a sense of what's happening in the trading room.
Well, we have more of an investment-based clientele, and we find that I think the clientele are a little bit worried that on one side, if the corporate fundamentals are right, if the selection of stocks in their portfolio is right, and if the companies who have been in which they have invested have shown the higher amount of growth projections, how could I think this company's stock prices fall beyond imagination levels? And that's where I think the people are a little bit more circumspect at this point of time. They are not losing confidence, but they want to have more confidence to buy into the market. Given the kind of a possibility of fall, I think at current levels, which may not be more, maybe I think 4-5% fall may be there from current levels. I think people are waiting before buying into the market. But certainly this time around, the nervousness is not there. They are basically anxious about, I think, taking the right call in the market with the time.
Okay. Sameet, let me get you in here, even as, Deven holds on and I go back to him on the fundamentals of certain sectors. 72.33 is where we are. A low not seen since about May 2014. As a chartist, what are the immediate support levels that you are looking out for, and what do you make of this volatility that we've seen?
See, the fall which has come in last 3 days was certainly unexpected for us. We were not expecting Nifty to break 70-40 quite so soon, but it has happened. Nifty has broken this important support level on an intraday basis. But if we look at the broader degree chart, Nifty has been moving within a 10 months downward sloping channel, and the lower end is now shifting lower, wherein earlier support was around 70-40. Now it has shifted slightly lower. 71.90 to 71.20 is a major support level where a lot of other technical indicators are converging. There's a 50% Fibonacci retracement placed around 71.20 of the large up move. Thus, we are not expecting substantial fall from current level. There's one more indication on the daily chart. We have now started seeing positive divergence RSI. This particular development happens in RSI when prices starts making low lows, wherein the corresponding RSI highs starts making higher lows. So that's a positive sign. So we are not expecting substantial fall from current level, and thus we are not advising our traders to short sell at current level. Rather wait for an opportunity to go long. We would rather wait for a reversal to happen on a daily or weekly basis.
Fair enough. Deven, I'm looking at the year-to-date performance of the top Nifty companies, and what stands out for me is that the two companies or two stocks that are still in the positive, among others, are of course Sun Pharmaceuticals and Infosys. You know, after yesterday's Cognizant scare, when IT companies cracked under pressure, there has been a bit of a bounce back. Is this the market trying to look at every safe haven, and is pharma and IT still a safe haven in this market given the negative news flow around them?
In fact, the names which you mentioned, Mini, both of them are showing some amount of visibility on the earnings side. Sun Pharma particularly having most of the negative part of the Ranbaxy integration is getting over, and probably I think in this quarter you would see I think maximum amount of integration process completed for Ranbaxy. Along with that, they have got a visibility of the earnings through the generic portfolio that they hold. So certainly I think this one company remains within the favorable list of investors, and I think whether you call it risk aversion or whether you call it I think higher amount of earning visibility, investors are looking at companies like Sun Pharma to invest in. Similarly, the situation with Infosys, wherein the management is very clearly guided that they are sitting on a brilliant possibility of bringing down the costs and at the same time taking care of the revenue in the business, I think through the newer initiatives like artificial intelligence, cloud and digital computing, and so on. Along with that, I think they also spelled out their appetite for inorganic growth. So all in all put together, I think the clear preference going into this company is largely because of the conviction remaining on a higher side. And at the same time, I think investors want to protect their capital from going down under. So that's where I think they're putting money into some of the safer zones like Infosys and Sun Pharma. Infosys particularly corrected from valuation, I think is becoming an opportunity also at the same time.
You know, the deepest cut has been on the PSU bank front, Deven, and look at the numbers that we saw yesterday from Punjab National Bank. This week we have SBI and Bank of Baroda coming out with numbers. Before I get Deven's view on this, I'm going to go across to my colleague Hiral, who joins us with a perspective on how bad the picture is looking for PSBs in this market condition. Hiral.
That's right, Mini. As you mentioned, asset quality concerns, higher provisioning and erosion of profitability, major concerns surrounding the PSU banks. If you see the YTD performance of these banks, firstly, if you see Bank Nifty here, the white line down by around 13%. But out of which, if you see PNB, the green line down by 28% on a YTD basis. So major erosion seen on this counter, which is followed by Bank of Baroda. If you see down 24%, the yellow line here. And lastly, if you see in terms of our SBI is concerned, which will be reporting earnings tomorrow, down by almost 27%. So all of these three counters, the major banks down in the range of almost 25 to 30% over the last on a YTD basis. And now if you move on to the smaller banks, if you see that chart as well, the pressure continues on the mid-cap counters as well. If you see OBC, which is the yellow line here, down by 19% on a YTD basis. Allahabad Bank, which is again the green line, down by around 34%. And the maximum erosion has been seen by IDBI Bank here again, down by 39%, which is the red line here. So if you see from the high that it has started, the way the erosion has happened, and over the last couple of months, we have not seen any growth in terms of where IDBI is concerned as well. So overall, the picture is looking worse when it comes to where PSUs are concerned, when it comes to NPAs as well as profitability erosion and higher provisions.
Right. Let me get Sameet into this conversation. Sameet, what's interesting is that, you know, in the fall in January, even the private sector banks that had been seen as better bets had fallen very drastically. And after the last bout of numbers, we are seeing a revival of interest in the private sector banks. As a chartist, what are you making of this kind of free fall that we've had in banking?
See, from this entire space, our preferred picks would be Axis and ICICI Bank, though we might be trying to catch falling knife, but we would rather go by the assumption history repeats itself. These stocks are trading around their important support levels, not on smaller degree charts, on broader degree charts. For ICICI Bank, 200 to 195 is a strong support on monthly charts. So we would rather wait for a reversal to happen around those levels. Those who are willing to invest by keeping a time horizon of more than 3 months or so, they should rather start accumulating in a staggered manner. 200 to 190, 95 would be a strong support zone for ICICI Bank. Likewise, for Axis, we are seeing a strong support zone around 370 to 360. All these are multi-year support levels. Thus, we are recommending our clients to accumulate this private banking names in a staggered manner. Probably they might consolidate for a while, but we see this as a very good buying opportunity.
Deven, with such a big portion of the market and the economy under stress, doesn't this put a question mark on any kind of clear recovery in the markets right now?
For market to recover, I think some of the external variables will have to show stability first. Currently, I think the crude and commodity related damages which are happening to the global investors, they are forced to withdraw money. I think some of the larger funds who are also employing their money into arbitrage, etc., they are also withdrawing money. So obviously, I think the fall is coming, which is not a natural fall. It's very unnatural fall. It is coming out of the pressure elsewhere. So unless we see some stability coming up into crude, commodity and currency, as I would put it, I think we will not be able to see very clear-cut, I think, direction as far as equity is concerned. I would like to see one by one each of these areas, I think, coming up to some stability level, after which one could very conclusively say that, yes, our markets have possibly stabilized or bottomed out. To my mind, I'm still maintaining the fundamentals are not weak or weakening. On the contrary, they are strengthening. The only problem with the market right now is the damage coming up due to, I think, the forced sell-off in some corners.
Right. In a market like this, we've also got some stellar numbers. Look at Apollo Tyres. That stock is up after the numbers. We've had a few companies come out with numbers that have beat the street. There are also companies that have stood their ground in a rout like this. Look at a couple of the iShares, Imami. These stocks have been real outperformers. Of course, iShare today is down about 1%. What do you like, Deven, in a market like this?
Well, I think we continue to operate with a relative amount of safety of margin that we find in some of the housing finance companies. We believe that I think at least 20% kind of a growth is given in this kind of a space, and some of the companies are definitely offering a good opportunity because they've corrected a price as well as valuation. So this is one area. Secondly, I think some of the better down stocks, particularly likes of SBI, likes of Reliance, likes of Tata Motors, Maruti, Bajaj Auto, such kind of companies which we believe that who hold larger amount of earning clarity and the growth prospects, so they should be once again seen to add it to the portfolio. And more importantly, I think there are many companies within the mid-cap baskets in agri commodities or in agri crop protection space or seeds businesses, or even for that matter, irrigation business. I think these kind of companies to be there in the portfolio. And in this fall, I think they give a lot of opportunities. So certainly, I think the names would be known, but at the same time, companies' fundamentals are definitely more importantly looked into as while speaking of this stock. So it is more stock-specific approach while looking at the theme within the sector.
Sameet, in a market like this, are you getting stock-specific stories as well as a chartist?
Yes, certainly. We are a bit on Reliance since last couple of days. We are seeing a strong support around 950. The stock is clearly moving in a strong uptrend. If we look at the daily as well as weekly charts, we can clearly see higher top, higher bottom formation. The stock has already fallen quite a lot from its recent highs of 1080. So it has already retraced its recent up move by 50%. 950, 940 seems to be a very strong support for Reliance. We are advising our clients it can be bought for a target of say 1030, 1038. and one can keep a stop loss at 915. Apart from that, we are also a bit on Apollo Tyres. Today it has given a good move. We have been bullish on the stock since the level of 140, 142. But the stock has a room to move higher from current level as well. We are expecting 158, 160 levels in next couple of weeks. So it can be bought on any minor dip. One can keep a stop loss somewhere around 136, 138.
Right. Sameet and Devin, thanks so much for joining us. Appreciate your insights on Bottomline. With that, it's a wrap on the show. We'll be back with all the top stories on the other side. Goodbye.